Hi, welcome. I'm excited to be here, as I hope many of you are excited. We're in the midst of seeing our industry shift from software over to SaaS, and it's a very interesting time to be here. I joined the software industry back in the early 90s when I started at IBM, and one of the first things I learned there was how profitable software companies could be. I then spent about the next decade within our services division helping companies outsource their infrastructure and their application support because they really didn't want to manage any of that stuff associated with their applications. And the other key thing that I learned during that time frame was this sort of precipitous spiral that the outsourcing industry was going in, where it was getting commoditized and profits were decreasing dramatically. And then about 7 years ago, SAP pulled me in to help bring out a couple of their first SaaS offerings to the marketplace. And that was the first time we got a product to the customer within 3 months, and they loved it. And so it was the first time I got to realize how much customers really loved SaaS. And since then, I've spent the last 3 years at PwC with the luxury of being able to go through and see about 10% of the SaaS industry and what's working inside, underneath the covers, both private and public companies, and figure out what's really making them successful. So SaaS is great. One of the reasons is it takes all that capital risk that the buyers used to have and it transfers it back over to the vendor. And now that vendor's got to hold on to all of those assets to run that software, and they've got to take the risk of making sure that the customers are really successful with it. And buyers don't really have to worry about that anymore. So that's a real great benefit there. But if you're one of those SaaS providers, how do you take your strategy and move it over to execution? And that's what we're going to talk about here today. So we'll start assuming that you've got your strategy already laid out, we'll take you from identifying those strategic objectives, figuring out how you generate value, what those operations are behind those activities that generate that value, and what those key measurements are, both for what you're producing and how well you're producing it. And then we'll start to take a look at other drivers that are out there that influence your production. So these are sort of internal or external drivers which are impacting your production. And then finally, we'll take it to execution and show you for each of those metrics, how do you sort out which ones you really want to put incentives behind to start driving behavior within your organization to make sure you achieve that strategy you set forward. Oh, go back here. So we just completed our 17th Global CEO Survey. I pulled out 2 pieces of information here that might be interesting to you. They're salient to this discussion here. First one's not much of a surprise, but most CEOs are looking at the next year. They're going to try and grow their companies through innovation and grabbing more market share. So that's fairly consistent with all the C-suite that I talked to. No surprises. Next one is, what's that planning horizon that most technology CEOs are looking at these days? And as you can see here, predominantly it's 3 years. They're looking 3 years out. That's what they're trying to target and get to. So let's get back to that strategy and what your objectives are. Here are 5 high-level objectives that most companies will start to consider. And what you need to do, in fact, what I'll do is, if the demographics still hold true from the last conference that we had last year, about a quarter of the attendees were either investors, founders, or CEOs. So I'll just assume we've got the CEO sitting over here. The majority of the other attendees are largely broken out between 2 groups, people focused on customer acquisition and customer retention. And sort of the 4th group is just corporate functions or product folks. So let's get back over here to the CEOs and get them focused on what they need to do to help the rest of that organization execute. And first thing you got to figure out is, what are your objectives going to be? And in this first example that we're showing here, this is like WhatsApp. They didn't have any revenue. It was all about adoption. They're growing crazy rates going into the texting market. So they had really good market share developing over there, but no revenue. And they still got $19 billion. So why'd Facebook do that? I mean, they're either stemming the competition, they're trying to buy some technology, or potentially they saw some long-term value they're able to get out of it, and they were willing to put that money out there to get it. So kind of an anomaly. There may be others out there, but we got to consider, is this what your model is going to be, what your strategy is going to be of how you're going to get money in your next valuation. So let's go from that one. Let's go to traditional SaaS players, and that's what you're seeing here. So SaaS is great. I mean, you start to enjoy these CAGRs that are 30 to 40%. It's much higher than the average for the typical software company that's below 10%. So that's one of the attractive features here. You got to get those revenues, you got to show the growth rate there, you got to capture the market share. And that's what all the private investors are keen on right now, trying to buy into those SaaS companies or software companies moving over to SaaS so they can get some of that valuation at the next recapitalization event that happens. But, if it goes on here, there's a few private SaaS companies out there that are actually profitable right now. They're very discrete markets. They tend to be the dominant player within that market. And they're cranking out a lot of income right now. Not many people know about that. It's not public because they're all private, right? So there are companies out there who've figured out how to make the SaaS model profitable. And I think what we'll see as the market continues to evolve over time and mature, more and more companies are going to be forced to go down this path to figure out how to become profitable. So first thing you got to do as the CEO, you have to go and figure out what your strategy is, what those objectives are, and then communicate it out to the rest of your organization. Because as you'll see in the remaining steps, they need to understand that strategy to be able to identify the right metrics and set the right targets associated with them. So here's some industry data. It's from CB Insights. It's a great data analytics source for private funding events and exits that are going on. What you see in that top left small box, that's the amount of capital that's flowing into the software market in the last year. So it's about $6 billion, 784 funding events that went on. That big right box is sort of a proxy for SaaS. It's actually the largest subsegment within there, represents most of the SaaS companies, but you can see $37 billion flowing in there. 6,000, almost 7,000 deals going on. So it's about 8 times as much capital flowing into SaaS companies versus software companies. And if you talk to Anand, the CEO of CB Insights, he'll tell you that his gut feels that the ratio is actually much higher than that. So now let's look at some of those valuations that happened when funding events occurred. Here, again, the same period last year or so. First thing you notice is there's a lot of late series investments going on. So a lot of these companies are holding off from going public, or they're burning through cash. For whatever reason, they're going through and getting much later series than that typically happens. The other thing you'll notice, huge multipliers out there, 41, 20, even down below there's a 44, 34 times a multiplier. That's unheard of in the software industry. So this is what's attracting all the private investors. All the VCs, they've been in this space for a while now, but now you have a lot of private equity funds trying to come in and hedge funds. They're trying to figure out how they get some of that multiplier in the next exit event that happens. So what about the public market? They come and they look at they look at GAAP and our traditional income statement metrics, and they see charts like this, and it doesn't make sense to them. It doesn't compute. I mean, they see the high growth rates that's happening for SaaS companies, but when you see the bigger the SaaS company gets, the more money it loses, it doesn't quite make sense. So what's interesting here, there's about 43 public companies right now that are just SaaS. There's 354 that are private. So again, this gets back to something that Mark Andreessen was talking about in his podcast a couple weeks ago. There's a lot of private SaaS companies that are making it, but they're choosing to stay private. They're selling to other private investors. And it's because they know the public market doesn't quite get their business model yet, or the SaaS economy, as Tien talked about it before. So there's a backlog of these companies that are there, and they're still trying to figure out how to make it successful and how to find the right investors that want to buy into them. So let's look at SaaS profitability. This is our enterprise profitability framework of how we break it out. It's nothing really surprising there. It's just a standard income statement. Yeah?
Go back to the prior slide.
Sure.
Study it for a second.
Yeah.
Oh, sorry. Just run over that one. The cost of goods. You went through it so quickly. I just want to make sure we.
Yeah, so this is for the OpEx engine.
No, that's good.
They do benchmarking. This is their 2013 data. I'm not sure if they've released the 2014 yet. But this is just going through cohorts based on revenue, the size of companies. You've got the private companies that's small, medium, large. Public are all larger than the largest private. And you can see the breakout of the income statement. And it gets progressively worse the larger the companies get. But hidden within those 354, there's a handful that are profitable.
What a dismal slide. Thanks.
I think it's the only red I have in the presentation. Okay, so So for new entrants into SaaS business models, these are the 6 key metrics that they start to focus on at first. So annual recurring revenue, I think we've all heard about that. One of the key insights here is for the pure SaaS players who really get this market, they're trying to keep their revenue mix, specifically the annual recurring revenue portion of their revenue mix, above 90%. And the reason why is because anything below 10%, any unique revenue stream below 10% is not considered material by the SEC, and you don't have to report it separately. So as long as you can keep your ARR, your recurring revenue above 90%, everything gets characterized as recurring revenue. And that all helps that multipliers that we saw earlier. So that's one of the key things they're trying to do there. For hybrid SaaS companies, as they're doing that transition over, it's a real struggle for them to get rid of that non-recurring revenue. So they're just really trying to get to 80% so they can at least argue that they deserve those higher multipliers for a portion of their revenue mix. But that's annual recurring revenue. Annual subscriber growth, that's not really profit, right? I mean, that's the farthest proxy from profit you can get to, but many companies start with that. And they argue, hey, we're growing like crazy, we're grabbing all the market share. At some point, we'll figure out how to become profitable, and all of a sudden, we'll switch over. So cost of revenues, controllable churn, that's basically discounting for any loss of customers you have due to mergers or acquisitions, sort of outside of your control. Retained annual recurring dollar cost. So this is how much are you spending to acquire each recurring dollar of revenue that you bring in. Time to market per feature, that's a good R&D one, because you're trying to get the minimum viable product out as quickly as possible. And then your sales and marketing costs, the first thing to focus on there is new annual recurring dollar costs. So this is how much are you spending to acquire each recurring dollar. That's the first key efficiency metric for a sales and marketing organization. So they start off here, then they go to some progressively more advanced metrics that are either getting you closer to profit or they're becoming more leading versus lagging indicators. And you can just see it's just an evolution of those metrics as they move on. And for some of the leading SaaS providers out there, you can see some of them are actually reporting on EBITDA because they're generating it. Many are tracking it because they know at some point they're going to have to do it. And I'm sure most of you have heard of Bessemer's 6 C's of cloud computing. Here's 4 of those 6 C's that they talk about as the key metrics to monitor the health of a SaaS company. And what's interesting to note here is customer lifetime value and CAC ratio. Most SaaS companies don't measure those initially because it's too foreign to them. They haven't quite gotten it yet. So they're focusing on the ARR and the churn, which is the most important thing to hit off the bat. So what we're going to do now is do a little deep dive on that new annual recurring dollar cost, which is really a precursor to getting over to the CAC ratio that Bessemer recommends. So let's dive into that one. So here's an example of a client where they went through and they were managing their recurring dollar acquisition cost. And it's really, again, in this particular case, when they started off for this product line, they were paying $2.86 for every recurring dollar they were bringing in the door by their sales and marketing organization. And over time, with each of the different years, as they started to acquire more and more recurring revenue, as their sales force started to build and they brought those dollars in, they got more efficient in how they were bringing in those dollars. So they spent less and less to acquire each dollar. The break-even time started to come in narrower and narrower. So what's interesting here, the key thing is as you have a group of people, in this case sales and marketing, selling a product that they've gotten used to and doing that same sales motion over and over again, they start to produce more and more, and they get more efficient as they do it. So nothing mind-blowing there. It's basic operational approach, but as production increases, your rate of production should improve too. So now let's start to focus in and ask yourselves, how do you guys actually produce value? And we'll focus first on the customer value chain. Basically, most SaaS companies focus on acquiring customers, then you get them on board, and then you try and retain them. You're also focused on product. So you got to develop those products, introduce it to the marketplace, get those first customers that are buying it, being your reference customers, and then you enhance them. And you've got employees. I mean, there's a talent war going on right now for skills. So you got to go and attract those people. You got to hire them, enable them, give them something of value so they want to stay with your company. Then you got to retain them over time. So let's do a little bit more of a deeper dive here because customer, that's really at a high level there with those 3 phases. If you go into onboarding, it breaks out. Just imagine that what you do is you set up, you provision a new tenant for your client, you configure it for what they're going to do, you entitle all the key users that are going to use it for that first batch, Then you go through and do your enablement. So you're going to train them on how to use that product. And then you go through and launch it and get that first day one value realization to make sure that the first set of users within the company are getting value out of it. So let's go into enable. Let's take it down another layer below that. So when you go to do enable, first you have to plan how are you going to do that training, who those stakeholders are, or the key users are you're going to have to train, put them through that training, and then you have to follow up with them to make sure they have everything they need for that first day that you launch it. So here's just an example of how you can identify some high-level activities that you do and start to drill down deeper and deeper and understand what those discrete, unique activities are that you need to manage. And again, you go back to all your value chains and figure out which ones are most important, and the key thing you need to do is understand what those core internal activities are. And this thing's really going forward. Okay, so let's now move on here. Back up a little bit. There we go. Okay. All right, so now let's look at your operations. So what are you actually producing? So let's look at the customer value chain. For any activity you have, you're going to have some sort of input, and at the end of it, you're going to have some sort of output. So let's use acquiring customers as an example here. So just as an example, some of the inputs would be potential customers. Some of the outputs would be new product customers. You could also look at it and say there's potential annual recurring revenue out there or market share that you want to get, and then there's the actual new annual recurring revenue that you're able to acquire during that period. And then finally, you could say there's potential customer lifetime value out there in the marketplace I want to go grab, or profit pool that's out there, and then what do you actually acquire at the end of your acquisition process. All right, so let's go back and take another dive here. We'll go into onboarding. Give you another example. So here, you've already got the customer. You signed the deal, now you got to get them up and running. So your input is new customers, your output are enable customers. But it could also be the potential value you sold them on that they're going to get out of that product, and then their first realization of that value they're getting from that first use of the product. All right, so now let's dive down into each of those different activities. Here's what we were talking about before were primary metrics, what you're producing. The secondary level is how well you're producing, doing those activities or making that production. So this is just standard operational metrics at this point. There's 3 core efficiency metrics, basically yield, cost, and time. And then from an effectiveness perspective, if you can define what your quality criteria is, you can start to then go through and measure how many of those outputs met that quality criteria. So that's sort of the generic approach there for each of these activities. Again, we'll dive into customer acquisition here. You'll start to see some standard terms that we're all familiar with and some new ones. So conversion ratio, this is just your demand conversion ratio. For all the marketing spend you do, how many of those actually turn into new customers? Customer acquisition cost, well, we all understand what that is, I think. But here's that recurring dollar acquisition cost, which is really the dollarized unit version of it. And in some cases, like measuring the time for when you start marketing, for when you sign a deal, might not make that much sense. So you might find a situation where there's a metric you really don't want to track, or maybe you don't have the means to track it at this point. And then here's an example of effectiveness. If your strategy defines that you want to move and acquire more of a particular customer segment, you could define those as your strategic customers. And then you can start to measure how many of those deals actually acquire that strategic customer segment you're going after. And that gets you your strategic alignment. So we'll dive down a little bit deep here and give you another version of it. This one's for selling. So acquisition, you're going to market, you're going to qualify, then you're going to sell. Now we dig into sell, and here's win ratios, very standard metric we've seen before. But customer sales cost, most people don't talk about that. Recurring dollar sales cost is the unitized version of that, but that's a great metric to measure your sales force only on. Take out your pre-sales, take out your marketing, just focus on your sales force and see how good they are at selling. That's a great metric. Days to close, that's a pretty standard one. I think everybody understands that. And again, the same quality criteria or effectiveness metrics for strategic deals I used in this example. So win ratio, those yield rates, what's that really getting you towards? If you measure that, it's really adoption. The better you are driving your yield rates up, the more people you're going to be able to adopt and keep throughout your whole value chain. Those cost ones, well, when you start to focus on contribution, that's where you really have to start to focus on the cost metrics, because that's how you're going to start to drive the difference between your top line and your bottom line and get the margin out of it. Days to close, Well, that's either going to impact customer experience or it's going to impact you as you're trying to scale over time when you're growing. And the ones on the bottom, those should drive your strategic alignment. So those are the ways you use each of those operational metrics. So key thing here for your operations is understand what your primary production metrics are and understand what your secondary operational metrics are. I'll move on here. Now, next step is drivers. So now we know what we're producing, we know how well we're producing it, but what else is impacting our production? And that's what these drivers are. There's internal drivers. These are the resources you apply to do those activities, and those are usually constrained by either the budget you have, the amount of people, or the quality of people that you have, the tools they have access to, and any other activities you might be expecting your company to do. And then there's external drivers. So this is how your partners are helping you, or what your competitors are doing, or how the competitive or market conditions are changing. Most importantly here is your customers. Here's where you start to tie in your customer experience. So all of these make up tertiary metrics that you can then focus on. And here's another view of those. It's just a different way of doing it. This is a systems dynamic model. And again, you're seeing everything you're producing, those activities in between them, and now we're highlighting samples of internal drivers that you have control over and their causal relationships, how they positively or negatively influence each other. And then here's an example of some external drivers. Okay. So key thing here is understand what your key internal and external drivers are and how they relate to each other. So I mentioned customers as one of the key external drivers. One of the ways to figure out what you measure there is by doing a customer journey map. So you can often start with a hypothesis here of figuring out what stages, what activities your customers go through as they interact with you or your product. And then within each of those stages, figure out what activities they do in that stage. And then you look at those and you figure out, okay, which of those activities are ones that sort of moments of truth happen. Let me back up here. And those are the bold ones there where people get really happy with you or they get really pissed off at you. And you really got to notice when you're creating those detractors because those are the points where churn starts to happen. So if you can understand that and start to manage those and start to influence what that experience is that your customers go through, you're going to have a much better chance at improving your churn ratios. So this is something I lifted from Tatango. I love the graphic that they use there. But basically what you're trying to do is understand that map, that customer journey map that they're going through, and you're trying to get those people, your customers, to be more and more successful over time, to adopt more and more of your features, get more and more users onto it. But you need to be able to identify those points where you're developing those detractors, where churn's starting to happen. And what you can start to do now, once you know these primary, secondary, and tertiary metrics, you can start to monitor those real time and start to look at your historical data. You can do regression analysis against it and start to figure out which customers are continually being successful and what are those steps that they go through, what's the timing between those steps, and you establish those patterns of success at that point. And then you can start to know when new customers are deviating from that pattern. And you can go in there and start to interact with them and make sure that everybody's staying on that green path as much as possible. Okay, so last step, execution. So based on your strategy, you need to set targets for all your primary production metrics. Some of those secondary metrics, remember I told you some of those might not make sense for a particular activity just because you can't track the metric or it's just not that important. And then some of those tertiary metrics you want to track too. So I tend to get my clients to focus on all the resources within your company that you apply to those activities, plus the key customer experience interaction points that are going to drive churn. So once you've figured out which of those metrics you want to put incentives against, the next thing you have to do is sort of judiciously evaluate whether or not that incentive is going to drive material impact and whether or not it's going to create positive behavior within your organization. So get to a little bit more detail on that in the last slide, but the key thing here is the fifth step is just determine which metrics you want to incent and when's the right time to incent them. So here's where the devil in the details starts to come out. So I'm just mapping out the resources for a company here. I'm going to start at that bottom layer. So here's your executive corporate platform resources. Those tend to be fixed. They're not really going to vary with the size of the company. What's really going to vary is the nature of the resources you have there. As your company starts to evolve, you might want to have higher and higher skilled people moving in there. You go up to the next layer. Now all of a sudden you've got HR and IT. These organizations are going to grow as the number of employees you have grow. So now, as that starts to scale significantly, you might want to consider putting in some of those operational metrics in there. Now, here's the layer that really gets impacted by scaling. These two layers are dramatically impacted by the number of customers you have. So if you start at that bottom one, your marketing and sales, that's really impacted by how many new customers you're trying to bring in within a given period. Account management, that's really driven by how many existing customers that you have that you're maintaining relationships with. And then operations, that'll vary by both. But in general, it's customers that are impacting how many transactions they're doing. If you go up a layer, now all of a sudden you have resources that are dedicated to particular products or product areas. And if you're looking at onboarding, again, they're impacted by the number of new product customers you're bringing on board, where support's really driven by how large your install base is. And you go up to that last layer, and now you have developers and product managers. These types of resources, again, it's like the bottom layer. They really are, the quantity of them will increase with the number of products you have, but it's really more so the quality than the nature of those resources change depending on the life cycle stage of your products. So when you're starting to develop products, what you want to do is start to incent those product-specific resources on time to market acceptance. It's all about getting your product out to market, getting the right product out to market as quickly as possible so you can test it and make sure it's viable. As you move on to products that are in the introduction stage, now you have to have a separate set of people that are really focused on how do we get those first customers up and running and successful? How do we document that process of doing that? And how do we make it extensible so the rest of our organization can learn to do that as we scale? So there you want to really drive market adoption. So some of those customer production metrics become key here because you want to show that adoption growing over time. And then once your products move into an enhanced stage where they've been out for a while, this is where you really got to focus on contribution, generating that contribution that's going to help your overall corporation get to a profitable state. So here's where you start to focus in on some of those cost metrics and making sure that you're driving down your efficiency or increasing your efficiencies over time so you can get more margin out of those more mature products that are out there. So key thing here is apply your incentives based on the scaling and product life cycles within your company. And here we are at the end. So first thing is, CEOs, you guys have to figure out what your strategy is, set those strategic objectives, and communicate it out to the rest of your organization. Then the rest of the organization, you got to really understand how you're generating value, what those key activities you are, either for your customers or the products that you're bringing out there or your employee base. Next, you got to determine what your production and operational metrics are going to be. And then understand what those key production drivers are, those internal and external factors that impact your production. Which are the key ones that you want to measure? And usually those are the resources you apply internally or your external customer experience and how that impacts churn rates and adoption. And then finally, determine what the right targets are to execute against. So there we go. Took you through all of that. Hopefully it made some sense. Any questions?
Yeah, I'm not sure what the other people in the audience are thinking, but we probably measure less than half that stuff today. Mm-hmm. And at what stage do you think an organization should be at the point you're suggesting here? Is there a revenue threshold?
So, I mean, part of what we see, there's a pattern when SaaS companies get to about $50 million in annual recurring revenue that they hit an inflection point. And that's where they really start to increase their CAGR. That's one of the key points you have to start focusing on, measuring any of those factors that are going to impact contribution. You might not want to drive incentives on contribution at that point because you still want to get those great growth rates, but you have to start measuring those factors because at some point you're going to have to put down the screws and make sure that you become a profitable organization in the end. Does that help? Yeah. It's nuanced. There's a lot of different details. But it's probably worth a more detailed discussion. Any other questions? All right. Thanks for your time.